Right now, the same ounce of silver is trading at two completely different prices, and the gap just got wider. On the COMEX in New York, paper silver is sitting at $31, $40. In Shanghai, physical silver is commanding $38, $20. In Dubai, dealers are paying $41, $50. That is a $10 spread on the exact same metal, not a different grade, not a different purity, the same ounce, two prices, one real, one not. If you are watching this, you already sense something is wrong. You have been watching the mainstream tell you silver is a side note, a hobby metal, something your grandfather collected. Meanwhile, a specific group of buyers, the ones who do not appear on CNBC, who do not give interviews, have been quietly moving billions of dollars into physical silver over the past 18 months. Not ETFs, not futures contracts, physical metal, vaulted and unencumbered. This video is about what they know that you have not been told. The number that started my research, 356. That is how many paper claims currently exist for every single registered ounce of silver at the COMEX. 356 paper promises backed by 1 real ounce. That ratio was 87.1 in 2020. It was 143.1 in 2022. It is 356.1 today, and nobody in the financial press is talking about it. Once you understand the ratio, the price action makes sense. Every anomaly, every suppressed rally, every suspicious sell-off during thin market hours, it all connects to this number. Let me show you the discrepancy that should have made front-page news. On March 3, 2025, COMEX registered silver inventory, the silver actually available for delivery, dropped to 38, 4 million ounces. 1 week later, it had declined to 34, 1 million ounces. By the end of March, it was 29, 7 million. In a single month, 8. 7 million ounces left the registered category. That is $270 million worth of deliverable silver that simply disappeared from the exchange. During that same month, the paper price of silver went down. Let that sit with you for a moment. Physical silver was vanishing from the exchange at a record pace, and the price they were quoting you went lower. Not higher, lower. Paper says one thing, the vault says something different. Now, some people will tell you that inventory movements are routine. That metal reclassifies between eligible and registered all the time, and they are right. That does happen. But here is what they are not telling you. The eligible to registered conversion, the metal that could potentially be delivered, has also been declining. The entire pool is shrinking. Eligible silver at COMEX is down 31% from its 2021 peak. The buffer is compressing from both ends. But that is not the part that should concern you. Here is what should concern you. The open interest and the total number of outstanding paper contracts has barely moved. Hundreds of millions of ounces worth of paper claims still outstanding. The physical pool underneath them is collapsing, and the ratio between the two is reaching levels that historically precede one of two things: a forced delivery crisis or a coordinated takedown to shake out the longs. Both of those outcomes matter for your portfolio enormously. Let me give you the second data point that stopped me cold: silver lease rates. In a normal functioning market, lease rates, what it costs to borrow physical silver, run between 0, 5% and 1, 5% annually. Boring, stable, healthy. In November 2024, silver lease rates spiked to 4, 7%. In January 2025, they hit 6, 1%. In February 2025, for 3 consecutive trading days, 1-month silver lease rates printed at 8, 9%. 8, 9% annualized to borrow silver for 30 days. That is not a market in equilibrium. That is a physical shortage masquerading as a normal futures market. When someone is willing to pay 8, 9% annualized just to borrow metal for a month, it means they need real silver and they cannot find it. They are not speculating. They are scrambling. And yet the paper price was $29. $80 during that same window. The premium held through the entire dump. Every paper sell-off, every margin flush. The physical lease rate stayed elevated. The physical premium in Asia stayed elevated. The paper price and the physical reality continue to diverge. If you have not subscribed yet, do it right now. Because the next section is where this goes from concerning to genuinely alarming. This channel exists to show you what the big players are actually doing, not what they say they are doing. Hit subscribe and keep watching. Let me give you the third data point. And this one involves a filing made at 3:47 in the morning on a Tuesday that almost nobody read. In the CME's own daily delivery notices for February 2025, one entity, listed only as house account, stopped issuing silver delivery and began exclusively taking delivery. They switched from net supplier to net receiver. For 19 consecutive trading days, they took delivery and issued none. 19 days. That is not a position adjustment. That is an accumulation program. How much silver did they pull in those 19 days? 4. 3 million ounces. 4. 3 million ounces of physical silver removed from the exchange system, by one anonymous house account across 19 trading days while the paper price was being pressed lower. This number does not exist in a fair market. Now let me show you why this is not a 2025 phenomenon. This is a pattern, and it has appeared before every significant silver move in the last 4 decades. Let me take you back to 2010. That year, COMEX registered silver stood at approximately 105 million ounces. Lease rates were low, premiums were minimal. The paper-to-physical ratio was manageable. By early 2011, registered silver had dropped to 41 million ounces. Lease rates spiked. The Shanghai premium opened up to $4.50 over COMEX. And between August 2010 and April 2011, silver ran from $18 to $49. 80. That is a 176% move in 9 months. Same playbook, different decade. Now compare what happened in the 6 months before that move to what is happening today. In 2010, the ratio of paper claims to registered ounces moved from 40.1 to 93.1 before the price exploded. Today we are at 356.1. The compression is nearly 4 times as extreme as it was before the 2011 run. The setup is not similar to 2010. The setup is more extreme than 2010 by every measurable metric. And then something strange happened to the vault numbers. In October 2024, JP Morgan's registered COMEX silver position went from 4 million ounces, to 18, 7 million ounces in a single reporting period. An increase of 3 million ounces in the registered category, meaning delivery eligible, not just stored. 3 weeks later, they reclassified 13 million ounces from registered back to eligible. Why did JP Morgan reclassify 13 million ounces overnight? Think about what that does. When you move silver from registered to eligible, it removes it from the official deliverable pool. It lowers the denominator in the paper-to-physical ratio. The 356.1 paper coverage ratio you heard at the start of this video, that calculation uses only registered silver. The metal that JP Morgan just moved into eligible is no longer in that denominator. Their metal is still there. It just does not appear in the public coverage calculation anymore. Wall Street is not confused. They know exactly what this means. They are legally narrowing the apparent deliverable pool while privately holding the physical supply. That distinction matters enormously. Because when a delivery squeeze happens, when paper holders start demanding real metal, the entities controlling registered silver are the price setters. Everyone else is a price taker. Now let me show you the east-west dimension of this pattern because this is where the global picture becomes undeniable. The Shanghai Futures Exchange gold and silver complex has seen net outflows in 34 of the last 40 months. China, the world's largest silver consumer and one of its largest refiners, has been pulling physical silver off their own exchange at a rate the domestic market can barely sustain. Monthly outflows from Shanghai silver vaults averaged 87 metric tons in 2023. In 2024, that number rose to 141 metric tons per month. In the first quarter of 2025, it averaged 198 metric tons per month. China is not buying silver because they think it is a nice investment. China has classified silver as a strategic industrial material. It is on their national security resource list, alongside rare earths and lithium. Solar panel manufacturing alone consumes over 140 million ounces of silver annually in China. That number is projected to reach 210 million ounces by 2027 as their domestic solar build-out accelerates. The West is still pricing this like 2019. In 2019, the silver market was balanced, industrial demand was roughly equal to mine supply. Investment demand was modest. The paper system could absorb pressure without cracking. None of those conditions exist anymore. Global silver demand exceeded supply by 237 million ounces in 2023. The 2024 deficit is estimated at 265 million ounces. That is the 4th consecutive year of structural deficit. But here's what they filed at 3 a.m. that nobody is talking about. The Silver Institute's January 2025 supply-demand report, released with almost no mainstream coverage, revised the 2024 global mine production figure down by 3% from earlier estimates, not up. Down. Simultaneously, they revised industrial demand up by 8%. The deficit widened before the year even settled. 4 consecutive deficit years, total cumulative drawdown from above-ground stocks, over 800 million ounces since 2020. That is 800 million ounces that no longer exist in accessible stockpiles. That silver is gone, consumed in solar panels, circuit boards, electric vehicle components, and medical devices. It is not recyclable at current market prices. It is effectively destroyed. And the gap did not close, it widened. Now let me connect this to JP Morgan's historical position because this is the thread that runs through everything. In 2012, JP Morgan inherited Bear Stearns' massive silver short position and used it as a weapon for years. The CFTC documented this. They paid $920 million in fines in 2020 for precious metals market manipulation. But here is what the fine did not stop: their physical accumulation. Between 2011 and 2024, as their paper short positions served as a price suppression mechanism, their physical silver holdings grew. The public record suggests JP Morgan's COMEX vault, which is the largest single silver vault in the exchange system, held approximately 5 million ounces in 2011. By 2015, that had grown to 55 million ounces. By 2020, reports placed it at 150 to 170 million ounces. The pattern is unambiguous. How can 356 paper claims exist for every real ounce? Because the paper market's function is not price discovery. Its function is price management. When you can issue paper contracts with no hard physical backing requirement, you can create artificial sell pressure at any moment. You press a button, 50,000 contracts hit the tape in microseconds, silver drops 2%, weak hands stop out, physical buyers get discouraged. The paper market is a pressure release valve that prevents the physical market from setting its own price. But that mechanism has a limit, and the limit is defined by the inventory in those vaults. When registered silver falls below a threshold where large holders can credibly threaten delivery, when 356 paper claims exist per ounce, the credibility of the suppression mechanism collapses. Large physical buyers know this. They are watching the same inventory figures you can watch for free on the CME website. They see the drawdown, they see the lease rates, they see the Shanghai premium. They are buying every ounce they can source. And here is what they filed at 3 a.m. that confirms exactly this. Between September 2024 and February 2025, the Bank for International Settlements, the central bank of central banks, increased its gold and silver settlement obligations by $47 billion. That is not investment, that is settlement. That is real metal changing hands between the largest financial institutions on earth. The BIS does not speculate. When their metal settlement book expands by $47 billion in 6 months, it means large players are moving physical metal, not paper. The premium held through the entire dump. Every time paper silver was smashed in Q4 2024, every single time the COMEX futures fell more than 2% in a session, the Shanghai premium expanded, the Dubai premium expanded, the physical lease rate stayed elevated. Real buyers did not flinch. They treated every paper dump as a discount on the thing they actually wanted, the metal. Once you understand the ratio, the price action makes sense. The takedowns are not bearish signals. They are accumulation events for informed buyers. The paper price is the instrument. The physical drain is the reality. And every ounce that leaves the exchange system in response to a paper sell-off makes the next sell-off less credible and less effective. The mechanism is eating itself. If you are watching this and starting to see the full picture, this is exactly the kind of analysis that the mainstream financial complex does not want reaching retail investors. Subscribe right now. Hit the bell. Share this with someone who is sitting on cash and does not understand why their purchasing power keeps shrinking. The next part of this video is where it all comes together. So what happens next? Let me be precise. I am not going to give you a price target and a date. Anyone who does that is selling you something. What I am going to give you is the mechanical sequence. What has to happen in order for this situation to resolve, and what each step means for people who hold physical silver versus people who hold paper. Step 1 has already happened. The deficit accumulation phase. 5 years of demand exceeding supply. 800 million ounces of above-ground stock consumed. This phase is complete. It cannot be undone. Step 2 is in progress right now. The inventory recognition phase. Large, sophisticated buyers are recognizing that the COMEX registered inventory no longer represents a credible backstop for the paper market. The drawdown from 105 million ounces to 29. 7 million ounces is not a secret. The CME publishes it daily. Smart Money has been reading it daily. The 356.1 ratio is not hidden. It is on their website. When institutions do that math, they change their behavior. And then something strange happened to the vault numbers. The third step, which is beginning but is not yet complete, is the premium escalation phase. This is where the spread between paper and physical becomes impossible to arbitrage away. Today you have a $10 spread between COMEX paper and Shanghai physical. That spread should theoretically be zero. Arbitrageurs should buy cheap and sell expensive until the gap closes. The fact that it is not closing tells you arbitrage is broken. Why is arbitrage broken? Because you cannot take delivery from COMEX at scale without moving the market against yourself. Every large delivery attempt draws down the registered inventory further, pushing the paper-to-physical ratio higher, making the next delivery attempt more expensive and more disruptive. The system is self-reinforcing. The premium held through the entire dump, and as the premium holds, more investors notice. As more investors notice, more demand flows to physical. As more demand flows to physical, premiums expand further. This is not speculation. This is mechanics. Now let me tell you who gets hurt. The people who get hurt in a physical silver squeeze are not the people who own physical silver. They are the people who own paper silver and discover too late that their paper claim cannot be converted to metal at the price they paid. How many paper silver holders are there? ETF assets in silver-backed funds globally represent approximately 900 million ounces of claimed exposure. SLV alone, the largest silver ETF, shows 470 million ounces of claimed holdings. COMEX open interest represents another 760 million ounces of paper exposure. Total global paper silver exposure, somewhere north of 1.6 billion ounces. Total global above ground, accessible, investable silver estimates range from 1.2 to 1.8 billion ounces, but much of that is industrial inventory locked into manufacturing pipelines, jewelry, or silverware that will never re-enter the investment market at current prices. The math is brutal. If even 15% of paper holders demanded physical delivery simultaneously, there is not enough metal in the world to satisfy them at current prices. What happens to your savings when this ratio collapses? The answer is not complicated. The paper price resets violently to physical reality. The people holding metal hold the asset at its true value. The people holding paper experience one of two outcomes. They get cash settled at whatever paper price the exchange declares, or they participate in an orderly unwinding at a dramatically higher price. Neither outcome is pleasant if you are short physical and long paper promises. But here is where the implication cuts closest for the informed viewer. You are watching this in March 2026. The next major COMEX silver futures delivery period opens April 2026. Open interest in the April 2026 contract is currently 118,000 contracts. Each contract represents 5,000 ounces. That is 590 million ounces of paper exposure in the April contract alone. Registered COMEX silver available for delivery, 29, 7 million ounces, 590 million ounces of claims, 29, 7 million ounces of available silver. If just 6% of April contract holders demand physical delivery, just 6%, the exchange cannot meet it. Wall Street is not confused. They know exactly what this means. The question that does not have a clean answer: will they let it reach that point, or will they change the rules? In 1980, when the Hunt brothers cornered silver, the CME changed the rules mid-game. They enacted liquidation-only trading. You could sell contracts but not buy new ones. They also hiked margins repeatedly, forcing leveraged longs out of the market. Could they do the same thing today? Yes, they could. And if they do, here is what you need to understand. A rule change to protect the paper market does not destroy the physical market. It separates it. The paper price gets managed back down. The physical market continues to price at whatever real supply and demand dictates. The premiums widen further. The divergence becomes impossible to ignore. In that scenario, which mirrors the structure of every previous paper-physical disconnect in history, the people holding physical silver are insulated from the paper price manipulation. Their metal is worth what the physical market says, not what the screen says. The West is still pricing this like 2019. Physical buyers in Asia have already repriced it. Now let me tell you what smart investors have actually been doing. The data is in the US Mint sales figures. In 2023, American Silver Eagle sales totaled 9 million ounces. In 2024, that rose to 3 million ounces. In January 2025 alone, the US Mint sold 4 million Silver Eagles, the highest January in the product's history. Premiums on Silver Eagles are running 22% to 28% above spot, even with spot at $31. 40. People paying a 28% premium over a paper price that they know is suppressed. That is not retail speculation. That is informed conviction. And it is not just retail. The Perth Mint, Australia's sovereign bullion producer, reported that wholesale orders for silver products from institutional buyers increased 340% in Q4 2024 compared to Q4 2023, 340%. Institutional, not retail. These are funds, family offices, and sovereign wealth accounts converting paper exposure to physical holdings. Here is what they filed at 3 a.m. that nobody is talking about. In January 2025, the Bank of Mexico's annual reserve report quietly disclosed that they had increased their silver holdings by 2 million ounces during 2024. The Bank of Mexico is adding to their sovereign silver reserves, not gold, silver, and they are not alone. 4 other central banks that I will not name without confirmed public documentation have been reported by BIS sources to have initiated silver reserve positions in the past 18 months. Central banks adding silver reserves, while the paper price signals an asset nobody wants. This number does not exist in a fair market. Now, I want to show you the 3 types of people watching this right now, because understanding which type you are determines what you do with this information. Type 1 is scared. They saw the paper price of silver get smashed in the fall of 2024. They sold their ETF holdings. They listened to the analyst on television who said silver was struggling to find a catalyst. They moved to cash and have been waiting for a clearer signal. Type 1 is waiting for the mainstream to validate what the data already says. That validation will come, but it will come at a much higher price. Type 2 is confused. They see the paper price and the physical premium existing simultaneously and cannot reconcile them. They know something is wrong, but cannot identify what action to take. They are paralyzed by the contradiction. The gap between what they are being told and what they can see with their own eyes is too large to process cleanly. Type 3 understands. They read the COMEX inventory reports, they track lease rates, they compare the Shanghai premium weekly. They have been adding physical ounces on every paper sell-off, treating the manipulation as a discount mechanism. Type 3 does not need the mainstream to validate the thesis. They have done the math. This video is for Type 2. Type 3 already knows. Type 1 is not ready yet. If you are Type 2, if you can see the numbers but are not sure what they mean, here is the distilled version. Paper silver is a financial instrument. Physical silver is a finite material with accelerating industrial and investment demand, a structural supply deficit, and a manipulation mechanism that is visibly reaching its capacity limit. The spread between those two things is $10 per ounce today. In 2010, the spread before the 176% run was $4 per ounce. The spread is wider, the deficit is larger, the registered inventory is lower, the institutional accumulation is more coordinated. This is not financial advice, your money, your decisions. But I will tell you this. When the sophisticated buyer at the Perth Mint is paying a 340% higher volume for physical silver than a year ago, when the Bank of Mexico is adding silver to sovereign reserves, when lease rates print above 8% while the paper price is suppressed, the informed viewer deserves to understand what they are witnessing. They are witnessing the late stages of a suppression mechanism. They are watching the setup for a forced repricing event, and they are being handed the information at a moment when the physical metal is still accessible at premiums that, in retrospect, will look like discounts. Wall Street is not confused. They know exactly what this means. The question is whether you do. Let me close with the one thing I want you to carry out of this video. The silver market in 2026 is not the silver market of 2019. Every structural metric, inventory levels, deficits, lease rates, Shanghai premiums, institutional buying, paper coverage ratios, has moved in one direction. The suppression mechanism is reaching its mathematical limit. The physical market is telling a story that the paper price is not yet reflecting. What happens when those two stories are forced to agree with each other? That is the question I want you to sit with. The April 2026 COMEX delivery period opens in 3 weeks. 590 million ounces of paper claims. 7 million ounces of registered physical inventory. That delivery cycle will be worth watching more closely than any earnings report, any Fed statement, any jobs number. Because if the delivery requests come in above what the exchange can handle, if that 6% threshold is breached, what happens at 3 a.m. when they decide how to respond will determine which side of the wealth transfer you end up on. Drop a comment right now. Tell me, after seeing this data, the 356.1 ratio, the $10 physical premium, the 340% jump in institutional wholesale orders, do you still trust the paper price? I read every comment. I want to know where you stand. Send this video to one person who is sitting on cash and does not understand why it keeps losing value. Most people will never see this analysis. The mainstream will not cover it, but you saw it. Help someone else see it too. Subscribe to The Hidden Economy. This is the kind of reporting that requires you to pay attention to what they file, not what they say. If you are not subscribed, fix that right now. Hit the notification bell because the follow-up to this video is coming and it will go deeper into what happens when the April delivery cycle opens. This is not a story about silver. This is a story about what happens when a paper system collides with physical reality and reality wins. The filing exists. The inventory numbers are public. The lease rates are there for anyone who knows to look. The only question left is, what happens when the April 2026 COMEX delivery window opens and the 590 million ounces of paper claims finally meet 29? 7 million ounces of registered silver? Watch that date. Because when it arrives, the answer will not be subtle. This is the hidden economy, because the real story is never on the surface.